Hello, everyone. Thank you for tuning in to UOBAM's Pre-US Election Special, Investing in a Brave New World webcast. I am Barry Tay from UOBAM's Marketing Communications team. Before we begin, I would like to just go through a few tools to help you navigate the presentations. At the bottom of your screen are multiple engagement tools you can use. All the items are resizable and movable, so feel free to move them around to get the most of your console space. You can expand your speakers or slide windows, or maximize either to full screen by clicking on the arrows in the top right corner. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. We will try to answer these questions during the webcast, but if a fuller answer is needed or we run out of time, we will come back to you later. Throughout today's session, there will be several polls, and we would appreciate your participation. Lastly, a resource list is available with some of the material from today which you can download. Now, to start this afternoon's session, I would like to invite Mr. Chong Jun Ye, Chief Investment Officer at UOB Asset Management, to kick off with a topic that I'm sure is at the forefront of everyone's mind. Over to you, Jun Ye.
Thank you, Barry. Good afternoon to all. I think given the US election is just around the corner, with a contentious US election outcome, will it derail market confidence? We will start off with two poll questions. Who do you think will win the US elections? There are only two answers, Biden or Trump. Do you think a repeat of 2016 surprises, that Trump again win the US elections? We'll see the results. And it has been a very eventful elections for this time round with the pandemic, and also many issues. Okay, interestingly, is more than close to two-thirds. Actually, more than two-thirds is thinking that Biden will win this election. So for the next poll questions, what do you think the biggest risk around the US election? The contested elections, the Democratic sweep, Trump wins and is emboldened, continued gridlock, others, maybe a social unrest in US, given that how divided is the society now in the States. It will be interesting to see the response from the audience. I think a gridlock here will probably refer to Democratic continue to hang on to the House and Republican continue to control the Senate. Wow. That's interesting. It doesn't quite gel with the first answer. Trump will win and is emboldened. Wow, as the risk that, of course, we feel is facing the US. Democratic sweep is the probably most favored one. Okay, thanks for all the response. While there is currently a lot of US policy uncertainties hanging over markets, our base case outlook is for a Biden election victory that will be seen as more positive for the economy, markets, and particularly positive for Asian markets. Polls, betting odds, and models are pointing to a significant Biden lead, not just nationally, but also in the battleground or swing states. Markets are likely to be volatile, leading to the election due to policy uncertainties and the potential for a disputed election. The combination of holding the election in the midst of a pandemic and the unusual behavior of the president in not being willing to commit to accept the results of the election is unusual in American history. We will start out by highlighting that there is clear evidence of market pricing in high levels of volatility in November during the election period. As shown in the chart, the VIX futures is at the peak in November. There are several concerns markets have. Markets are worried about whether voting will be managed well in the midst of a pandemic. There are concerns that the result will not be accepted. The expected high level of mail-in ballots will lead to the result being delayed and allow for premature declaration of victory by either party. President Trump is showing doubt in the legitimacy of the election and has not been willing to say he will accept the results of the election. As many of you know, the US presidency is not decided by popular vote, but rather by the electoral count from winning individual states. Democrats have actually won the popular votes in the 6 of the last 7 elections, but have only won the presidency in 4 of them. Currently, Biden appears to have a safe lead in enough states that should give him the presidency. In fact, the closest races are what are perceived to be traditional red states. That is, Trump needs to win all the states that are close right now and somehow take a couple of the states where Biden is leading by more than 5%. There are several measures to see who is leading the race. The first are the simple average of the polls. Biden has had large leads that have been steady for months. In fact, the level of his leads is that perceived should be consistent with some of the largest landslide elections in US history. But as many are aware, the polls are not always correct. In 2016, many of the state polls were off by a significant margins. In particular, the polls did not align the education level of those answering survey with that of the standard population, since there was a bias for lower educated white voters to vote for Trump, and there was a distortion in the survey which skewed towards respondents who were college educated, and hence the polls error. Such missteps have since been corrected by polls, but it remains possible that some other unforeseen error may happen this year. We'll move on to the next slide. Next, we track the betting markets as a sign of who may win the election, such as the lines in spot betting. There's a lot of accuracy in betting odds, as individuals with real money on the line try to make their best estimates. The betting odds have been much closer than the polls, but lately have started to shift to Biden after the first presidential debate. We also look at election models that take into account polls, demographics, and historical state biases. And this model have also been breaking towards Biden since the debates by a large margin. Who control the legislating bodies of the Senate and the House of Representatives is also important to understand how policies may change over the coming year. Democrats currently control the House of Representatives and by all accounts appears likely to retain control. Currently, the Senate is controlled by Republicans. Polls and models are indicating that the Democrats are likely to take control of the Senate, though the margin is much closer than those for the presidency or the House. But taken together, the polls and the models are indicating a blue wave. A blue wave that is one that will see the Democrats getting control of the branches of government and should be in position to implement their policies without Republican roadblocks. Next, we look at the various policy differences between the Democrats and the Republicans and how they will affect different sectors of the markets. This slide contains many of the points we are tracking. Most broadly, we would highlight that policies regarding healthcare, climate, education, and trade are likely to shift. In the blue wave scenario, the fiscal stimulus package of at least 2 trillion early in 2021 would substantially raise output because A, the increase in government spending and transfer payments are much larger in dollar terms, exceeding current tax revenues. B, their per dollar impact and hence multiplier effect will be greater as well as broader in scope. This will involve significant level of spending that will be financed by higher taxes on wealthy individuals and corporates later on. So in conclusion, the Democrats are likely to achieve a sweep of control of the presidency, the Senate, and the House. And most broadly, we would expect the Democrats to implement Keynesian policies, i.e. bigger federal budgets for government spending, to counter the recession, which will include various healthcare, climate, education, and labor initiatives, which are likely to have wider multiplier effect for the US economy than Republican preference for tax cuts to spur growth. The spending in these areas are likely to come from raising the tax rate on higher income earners and corporates later on. We continue to anticipate high uncertainty and volatility over the coming months. Well, as the COVID-19 pandemic continues to spread, and whether the vaccine timeline will hasten recovery or disappoint investors, we will have one poll question to get your opinion. When do you think an effective vaccine or treatment will be rolled out to a large part of the world? First half of 2021, second half of 2021, or 2022 or later? And also the confidence among the people whether they are willing to take the vaccine even when it's being rolled out. It will be interesting to see the results from the audience. Okay, it's kind of market consensus that is second half of 2021. Will be interesting as I present our house view. At UOBAM, we have a team of economists and financial analysts who somewhat ironically have spent more time in the past 6 months reading medical papers than financial papers. And sometimes we joke around and saying they are the medical specialists now. But we think the path of the virus with the medical community's ability to counter the pandemic remains one important variable that would impact financial market over the coming year. Having spent all this time taking the medical progress, UOBAM has a positive view of the likelihood of this advancement making a difference to global economy and markets in 2021. These next few slides are a summary of where we think the progress is going to come from. And in these slides, we will highlight that the progress actually already made in reducing the case fatality rates. Second, the improvement in testing and treatment that we believe are advancing more than the market had hoped for so far. And our view that the vaccines are likely to be effective and will be rolled out in large quantity by second Q 2021. The first thing we would highlight is that the progress is already very significant, even before some of the most promising treatment and vaccines were approved. As you can see in the chart, back in January and February, the number out of China for the case fertility rates was over 3%. Well, the definition of case fertility rate, or CFR, the possibility of dying for anyone who contracts the disease. The rate have thankfully been falling steadily. The most recent estimate by the Medical Research Council in the UK is now as low as 0.3% versus the common flu estimated at around 0.1%. So studies by other countries are getting similar numbers. So if a little more progress can be made in treatment and vaccines, and the CFR gets closer to the flu, then we are likely to be able to get our lives back and live more normally again. And a big part of the reduction in the CFR is due to the advances made in treatment. Firstly, of all the understanding of best practices in care for COVID patients have improved immensely, such as knowing now the ventilator should be avoided as long as possible, proning or getting patients to rest on their stomach, basic nutrients like vitamin C, vitamin D, and magnesium are frequently checked and given. Knowing to look for signs of blood clotting, better understanding of blood marker and oxygen readings, and knowing how and when to react to them. So probably the biggest game changer for drug has been dexamethasone, which Oxford University published the detailed study on its use for COVID patients back in June. It changed global treatment practices for COVID patients overnight. Dexamethasone is a steroid that can be used for, to treat autoimmune problems. That's what happened when the immune system overreacts and starts to attack the individuals. Since most of the fatalities for COVID occur when the autoimmune system is overreacting, dexamethasone has helped to counteract the most critical part of disease intervention. Other drugs such as remdesivir are regularly used for hospitalized patients, and studies show it quickens the recovery time. Remdesivir is an antiviral drug that prevents the virus from replicating in our body. And there are more promising drugs in phase 3 trials that show a lot of promise. In particular, monoclonal antibodies and interferon beta look the most promising and could go a long way to lower COVID lethal rates. In fact, for your information, the treatment that Trump has received is a combination of dexamethasone, remdesivir, and monoclonal antibodies. The drawback is that it needs to be done well. I think this slide basically shows another important step that we have taken. The advances in testing have been really important, and we think most investors don't quite appreciate how meaningful the advancement in testings are. The most optimistic look at the new testing capability as a way of suppressing COVID while waiting for a vaccine. There are 3 main types of testing being done, as we put in the table. Until recently, there were 2 types. The gold standard, which is called the PCR test. It is very accurate and is given to diagnose any patient suspected of having COVID. The vast majority of the testing around the world today has been PCR testing. The drawback is that it needs to be done in a lab and thus slow and takes several days to get results. In places with significant outbreaks, it can take over a week. As accurate as PCR testing is, this makes it ineffective in letting people know immediately if they have caught the virus. The second major type of testing are the antibody tests. These are used to see if you have the COVID in the past. They are useful gauge to get a sense of what percentage of a community has already been exposed to COVID, but not letting that they have COVID. The new type of testing that is being rolled out now are what they call antigen tests. These tests are less accurate than PCR, but they are very fast and very cheap. Abbott, which is the medical device company, has been rolling out a fast 5-minute results test kit and also paper-based tests, as we showed in the picture. And this paper-based test work somewhat like a pregnancy test and can be done at home and can give result in 15 minutes. And they currently cost around $5, but it's expected that they can fall to as little as $1. The hope is that this test can be rolled out across the world. In fact, just for your information, the Singapore government overnight has also announced that as the country is preparing to further relax, the control, and they have introduced antigen tests, to basically test on a bigger crowd of people, and then people can, test more regularly, and patients will catch their cases much earlier and quarantine themselves earlier. So such knowledge could go a long way to containing the pandemic and for us to go back to our normal life. Finally, and most importantly, we think the progress on the vaccines has been very encouraging. Most surveys show that investors and the population in general are fairly cautious about the near-term prospect for a reliable vaccine. It's fair to say that no vaccine in history has been rolled out so quickly, and a typical timeline would be 5 to 10 years. The breakthrough in vaccine development and excellent strategic cooperation between companies and governments around the world indicates that the world could have a safe, effective vaccine produced in large number within a year of the outbreak. In fact, currently there are more than 100 vaccines undergoing trials now. There are 9 that are in phase 3, and in the table we have listed down some of them, and several more in phase 2 trials and about to start phase 3. The preliminary results of several of these vaccines look like they have a good chance of being effective. We think the phase 3 trial will likely be completed before the end of the year or early next year. There remain many questions regarding how quickly they can be produced in large numbers, how lasting will be the immunity, and how many will take the vaccine. We think there's a reason for optimism on all fronts. Governments around the world have been paying companies to start production even before trials are complete. Current survey have only a modest majority of people indicating that they would take the vaccine, but we think this number will improve as it becomes more common and requirement for things like attending school, for travel, and attending conference. So in conclusion, while nothing is certain regarding the rollout of treatments and vaccines, we think there is lots of room for optimism, and markets may not have fully appreciated the extent of the positive development. We think the case fertility rate, or the CFR, is already being reduced, and that it will decline further in the coming months, and probably close to the common flu kind of ratio. We think immunity is likely to be lasting, and vaccines should work and will allow people to return to more normal behavior in 2021. This will be positive for markets, and in particular, we think those sectors that have been held back will start to recover more fully. Travel and leisure in particular are among the areas that could benefit from a rebound by the end of 2021. So for the fourth quarter investment outlook, we are going to have a debate between a bull case versus a square root scenario. And I'm now to introduce my colleague Damo, our Chief Investment Strategy for UOBAM Invest, our digital platform. Welcome, Damo.
Thanks, Jinya. Good afternoon, ladies and gentlemen. Thank you for spending your afternoon with us. And I think for a start, I mean, you've heard so much from Jinya with regards to the vaccine as well as the US presidential election. Probably the most important thing is, what does that all mean? What does that all boil down to when it comes to market? I think before we start talking about what are the potential scenarios that we see, why don't I take a poll in terms of having a sense of where you think market will go. First question that we have is this: when do you think that the global economy will return to pre-crisis level of activity? If you imagine fourth quarter of 2019, when everything was hunky-dory and most economies were doing well, when do you think the world will get back to that level of economic activity? When will we close that output gap? Is it the first half of 2021, the second half of 2021, the first half of 2022, or the second half of 2022 or later, meaning that you think that we won't get back to late 2019, at least till the second half of 2022? Let's see how everyone feels in terms of the prospects for the economy. Okay, I see that we are split. Roughly speaking, about 70% of the audience feels that it is either second half of 2021 or first half of 2022. I think that's fairly close to where we think the economy, the global economy would be too, in terms of the pace of recovery. And then let's look at the second poll question then. Which scenario do you think is more likely over the coming years? Meaning, in the next 12 months, where do you think market would be? Do you think it is a bad case scenario in which that we see continued pandemic and a long time to market recovery? Two, do you believe in the square root scenario in which that we had a rapid initial recovery like what we saw in the last 6 months, and then we are actually going to see a sort of more range-bound market and small gains until the economy catch up? Or three, do you believe in a bull case scenario in which that we see a faster than expected recovery with vaccines and a fiscal stimulus driving markets, which end up showing a strong market in which that market will exceed what we see at its peak in February of this year? Which of these three scenarios do you think is most likely going forward in the next 12 months? Wow, okay. So more than 56% or more than 50% of you believe in the square root scenario in which that you see the market rebound and then sort of being range bound from here onwards. And I think that's fair. That's been what we have been proposing and advocating over the last few months, that we believe in this square root theory, where markets sort of collapse with the lockdown, and then as sort of government response to that collapse, with sort of easy monetary policy, as well as sort of the gradual unlocking of the economy, what we saw was a sort of a sharp rebound as market looked past the pandemic, and we actually started seeing that, and then we were basically proposing that we see that square root kind of recovery. But before we get there, maybe I'll bring Jinya back to explain a bit more of where that square root theory came about and how that's going to continue from here, how we may continue to see that square root shape play out. Jinya?
Okay. Thanks, Damo. And I'm happy that a lot of you are with me on the square root theory, as I'm going to argue or debate against Damo, who will be sharing his view on the bull case scenario. And this is a chart that we use in-house. And as you can see, the markets has kind of recovered from the low in March, and then looking like square root kind of shape, and we have attached of 40% for this square root range from here to next year, as the economy try to catch up with the markets, and of course corporate earning to rebound, in the second half of 2021. So what it means here is that the market will likely to be range bound around this 10% range from here on until maybe middle of 2021. But of course, we also have attached a 40% for the bull case scenario, where given such a low interest rate or zero rates environment, in some cases negative rates, asset classes can be more elevated, and with the recovery in some of the economic indicators that we have seen so far, should push market to even higher than the pre-crisis level. Then, not forgetting, we also have our bear case scenario, which I will delve into it a bit more later, that we currently attaching 20%. As I can see from the response from the audience, it's more around 10%, that people feel that we could be in a bear case scenario. So overall, this is our house view from beginning, first quarter of this year, when we started to see things recovering, start to see central bankers cutting interest rate down to zero, and a lot of fiscal stimulus being rolled out in many countries, whether it's in the developed country or emerging country. And that is the scenario, the base case that we have had since then till now. And at this juncture, we are kind of also debating in-house whether it's more a case of bull or still a square root theory going forward. But it's all within the square root theory, we also have this kind of a pattern that we have observed, which is in the next slide, a K-shaped kind of recovery. Basically, what you can see here, that the K-shaped recovery will differentiate between economies that are on the recovery path, especially in the North Asian country, and maybe in some of the developed countries. And as compared to the emerging economies that are still going through a lot of these pandemic issues, they are not getting out of the wood yet. And in the case of UK, of course, we have the Brexit, things that complicate things a bit. And then if you look at the sectors that have been performing in this rebound, are the e-commerce, technology, healthcare, pharma, electronic sectors that are going all-time high in some cases. Then you have the sectors that are most impacted by COVID-19, the tourism-related, the airlines, the travel, hospitality, and entertainment, that are still struggling and suffering, and will likely, to be the last one to come out. And maybe with the vaccine being rolled out next year, we could see some recovery in the second half of 2021. So this is basically where the square root scenario that we have been using, since the second quarter, and with the K-shaped recovery differentiating between markets, economies, and sectors, whether it's in the DM and the EM world. Back to you, Damo.
Thanks, Jianye. I think, Jianye highlighted the need to be fundamentally driven to basically to distinguish between companies, sectors, and countries that will probably do better in a COVID or post-COVID scenario versus those that are probably going to suffer a bit longer. I think that basically sort of the things that the situation that we see, that sometimes a very broad market, a broad index hides a lot of all these differences, and therefore I think the need to be discerning and the need to sort of distinguish what is working or what will benefit and what would. So basically, I think that basically points towards more active management, more active fund management rather than sort of buying a broad market, right? But as Jin-Ye sort of hinted, even internally, we are basically arguing and debating the increased odds of a bull case scenario. And actually, there's what we talked about just now in terms of a Biden presidency is probably one of the key pillars for us to be more bullish in terms of why we think market could actually recover faster or market could be stronger than where it is today. I think there's now you yourself basically said that, or 80% of you basically felt that Biden is going to win the presidency. And I think if we look at polls in terms of having a Democratic sweep, the chances of Democratic sweep is probably as high as sort of 60%. And we think that with that sort of environment, what we are going to get is we're going to get for immediately a relief rally because people were concerned about contested election. People are worried about election in which that there's no immediate winners. And so if we have a clear victor, if we have a clear result, I think that market is going to see an immediate response. We're going to see an immediate bounce. But I think even if we look longer, basically a Biden presidency and Democratic sweep would likely result in a massive fiscal stimulus, which would basically support industries or support rebuilding infrastructure, promoting green energy and promoting environmental protection. I think those would probably drive the economy, and we should see actually that fiscal stimulus will actually drive a faster than expected economic recovery as a result of that fiscal stimulus. And then we also need to be mindful that if Biden becomes president, we don't believe that Biden is pro-China, but what we believe is that there will be, at least on the foreign policy front, I think there will be more rationality. We won't see a lot of sudden flip-flops in terms of foreign policy, whether towards China or even towards Europe or some of the traditional U.S. allies. So with a more rational foreign policy, I think there will be greater certainty. I think that encourages people to be more. That encourages people to invest and spend simply because there's now more certainty in terms of outlook. I think that could only be good for the economy and for market, especially for Asia. Thirdly, basically, if we have a Biden presidency and we have a massive fiscal stimulus, I think the expectation is that we would see a gradual weakening of the US dollar. And generally that tends to be positive for emerging market and for Asia as a whole, in terms of we would see US investors looking outside of the US for investment opportunities, and that tends to be good for Asia, right? And today, of course, we are 1 quarter compared to what we've spoken last quarter. We are 1 quarter closer towards a vaccine, and I think that's definitely positive, right? And if we look at the latest economic data coming out of China, what we've seen is that China being sort of first into the COVID situation has been the first out, and we see sort of a lot of economic data normalizing out of China. And in fact, in certain aspect, the data is now actually higher than what it was in late last year. So basically, in some aspect, like retail sales, like consumption, certain parts of consumption, China has actually sort of fully recovered. I think if you look at even like auto sales is now actually stronger than what it was last year. So definitely in some of these aspects, we see impetus and we see drivers that calls for us to actually be more bullish, that we see more signs of bullishness, that we think that market could actually break the high that we saw early this year and actually make new high from here. So if we basically, go to the next slide, from the earnings front, what we are seeing is that basically analysts are projecting a sharp earnings recovery. I think this year the earnings collapse was about 20%. That's the expectation from analysts because of the COVID lockdown. But by next year, the rebound is actually more than 25%, which means that by next year, earnings would have more than recovered what it lost this year, and we would have exceeded the 2019 level. So this basically, again, suggests that we should see market exceeding the 2019 level sometime late this year or even early next year, simply because people start to price in the earnings recovery in 2021. I think that's basically our case for the call for bullishness. And part of this earnings growth or earnings recovery is really because, as what Jianye mentioned, in some of the sort of new economy or in the sectors that are doing well, think of your e-commerce, think of your online shopping. I'm sure many of you have turned to online shopping and been doing a lot more online shopping now. You've been doing a lot more calling for food delivery. Those new economies and things like technology sector, the earnings growth is really compensating a lot for the sort of earnings loss in some of the older economy. So therefore, this earnings growth could actually be driven by some of this structural growth story and structural changes, and we think that calls for bullishness in terms of market, right? So we are basically internally talking about increasing the odds or increasing the probability that we might see a bullish scenario rather than a square root shaped scenario. Right. So, but obviously we are also mindful that there could be some risk out there, and some of this risk could actually point to a sort of could tip the market into the bearish territory. Maybe if I can invite you back, Jianye, and talk about what are some of the risks that we are mindful of and watching out for.
Okay, thanks, Tao, for the bullish case. Well, not forgetting some of the bear case scenario or even the tail risk event that we could potentially still face in the coming months. I think one that is close to our heart will be, whether the election outcome will be a disputed one. And whether it will lead to social unrest, given that the society in the US is currently quite divided, or whether because of this mail-in votes that caused the delay, until the result of the election until January next year. And then on top of that, the COVID-19 cases could go into the third wave. We already seen the second wave that is higher than the previous one in Europe, and US is also rebounding up in terms of cases. And vaccines, as much as we hope it will be rolled out soon, may take longer time. If the approval were to be delayed or the efficacy of the vaccines are not high enough to convince people to take it, and hence the control of the pandemic will further delay out. So as a result, that will be our bear case scenario. But I must say, coincidentally, we have our in-house strategy meeting today, and we have kind of a debate among ourselves. The inclination is more going forward. The base case scenario, in terms of the probability, is likely to drop from the 20%, and the bull case scenario is likely to actually go higher from the 40%. So with that, I will turn it back to Tamo.
Yeah. Thanks, Jinye. I think you're right in a sense that there is also the concern for the vaccine. I think we had a couple of setbacks in a couple of the vaccine that are in phase 3 trials. I think there are definitely concerns that if some of the trials don't go as smooth as expected, I think there probably will be disappointment. And the other thing that I guess that people have been talking about is always whether that vaccine would be widely available, because we probably need sort of a big enough proportion of the population to be vaccinated before we can actually bring this under control. I think there are concerns about whether people are skeptical, people are worried about the vaccines, and no one wants to be the first batch or the early adopters to this vaccine. I don't want to say guinea pigs, but no one wants to be the early adopters of this vaccine. And if everyone adopts a wait and see attitude, and this vaccine doesn't get propagated as widely as expected, then basically that vaccination really doesn't work. I mean, or the vaccination program is not as effective, and then basically that might actually cause the pandemic to last a bit longer. I mean, obviously, what we have seen today is that we've seen, to a certain extent, a third wave, a possible third wave in the US and a second wave in Europe. Those are cause for concern, if it causes sort of greater lockdowns or tighter lockdowns as a result of that second wave or third wave before the vaccine happens, and I think market may actually take it quite badly. And I think those are probably some of the bad case scenarios that we are actually definitely watching out for. But in the meantime, we think that in 2 weeks' time, if the U.S. presidency is settled, I think we probably see a fairly positive or constructive outcome for market from that. Right. So basically, if to sort of wrap up our views in terms of market, we think that the economic and earnings recovery has surpassed expectation and will probably continue to do that. Our base case, we started off with sort of equal chances of square root and a bull case, but I think the idea is that we are now sort of tilting more towards the bull case. That's basically hot off the press or hot off the printing press. That's basically what we have sort of discussed or sort of concluded this morning among our strategy committee. Right. We think credit spreads have contracted through the quarter, but we think modest opportunities remain. I think both in terms of corporate credits as well as in terms of high yield bonds or high yield spreads. We think that there's probably some room for that tightening, simply because the market or investors are now struggling to find yield in risk-free assets, and I think they are gradually moving out the risk spectrum. And I think we think that sort of the corporate bonds and high yield bonds will probably be bought up, and with that, credit spreads has some room to tighten a little bit more. We think that there are still some risk. U.S.-China decoupling, as we mentioned, basically we don't think that Biden is pro-China. I think the sort of the Chinese that stands against China is probably one of rare few bipartisan position in the U.S. And Biden would probably still be hard on China, but I think we think that if it's a Biden presidency, at least that position will be more rational without it being emotional or flip-flopping. And just now we talked about the virus setback, the second wave, third wave, and whether the vaccine would be delayed or would be delayed in terms of being implemented. And I think those are probably some of the risks that we are seeing. And the third, and probably less talked about, is basically emerging market contagion. Basically, we acknowledge that this COVID-19 has actually taken a toll on quite a number of countries, especially in emerging market. Already we've seen some of the African countries or the South American countries feeling the pinch and feeling the strain of this COVID. And if the lockdown continues, we've actually seen downgrades in some of the sort of Eastern European or even the Middle Eastern sovereigns. And if this continues, we may actually continue to see that downgrade wave. And if we don't know if this might cause a contagion effect on emerging market, and I think that's definitely a risk that we are watching out for. At this moment, we are hearing sort of the supranational promising support, promising some debt relief, but it's definitely something that we're keeping an eye on, and we dare not be complacent on that. So overall, at this moment, we stay neutral equities, but we are actually turning probably a little bit more bullish on the risk assets. On equity side, we are going to turn probably a bit more bullish, and we continue to stay overweight in investment credit and underweight in government bonds. I think at this current low yield, we think government bonds doesn't offer much value, and in fact, the risk to it doesn't compensate us for the interest rate risk. We advocate owning a bit of gold as a way to hedge against inflation and against market volatility, and we are underweight cash. So that's basically sort of the recommended asset allocation. With that, we've come to the end of sort of the formal presentation. We'll probably be open to taking some question and answers from what you have sent us and from clients who's posted in our Q&A segment. So I'll let Jin sort of talk about, moderate this Q&A segment. Back to you, Jin.
Thanks, Damo, for the interesting market scenario that you have painted. And hopefully we can start having more questions coming in our chat box. And before this, we have a long list of questions from the registration. And we will probably take a few of them while waiting for some of you to give us some more questions in the chat box live. Well, the first question I want to pose to Damo: will Biden's win negatively impact the markets, at least for the short term?
Thanks, Junior. I think there's a lot of concern about. Initially, there was actually a lot of concern about Biden win and a Democratic sweep. I think the concern stems from two areas. One is the fact that Biden promised a tax hike across the spectrum, whether you're talking about taxing the high income bracket, raising corporate tax, even raising whether capital gain tax or dividend tax. And those are typically bad for equity market, right? So there's a concern that he may implement all those when he becomes president. The second thing that people are concerned about was about regulation. I think there are talks about whether on healthcare side or in terms of controlling healthcare costs, and even for tech stocks in terms of breaking up or regulating technology. I think these are probably the two main area of concerns that people see as a risk to market. And I think those are valid. But I think in the short term, that's probably not the top of his agenda. I mean, if we look at the most recent, his most recent speeches and his most recent talks, I think the focus is on the fiscal stimulus. And I think Biden is pragmatic in the sense that with the economy in the current condition, I don't think that it is practical for him to raise taxes at this current moment, right? The unemployment rate is still high. The output gap is still big. There's really no grounds to be talking about raising taxes at this moment. Talking about raising taxes will win votes, but at the end of the day, it will cause damage and you don't want to have an economic collapse or economic issue so early in his presidency. So what we think is that he would probably front load the fiscal stimulus and back load the tax hikes and the regulations. I think so. We think in the short term, in fact, it would probably be a positive. The negative would probably come in second half of next year or later. And hopefully by then, the economy will be on a stronger footing that it could take all those tax hikes in that situation. Of course, there's also a scenario in which that we still have a split Congress. And if we have a split Congress, then basically, in fact, it would probably, it's a mixed blessing in a sense that we may not have the tax hike, but at the same time, it also makes sort of fiscal stimulus more difficult to push through. So we think that at this moment, probably having a fiscal stimulus right now is something that is positive for market, and we think that by next year, when the economy is probably in a better shape, we can talk about a tax hike, and I think that's probably a fairly positive outcome from a Biden presidency, and a sort of a blue wave in terms of a Democratic sweep in both the presidency and the Congress. Yeah. With that, maybe I'll ask this question back to you, Jinyeh. I think I've seen this question being asked. If Biden really wins the presidency, what does that mean for Asian currency and by extension for Asian equities? I think for Asian currencies, there's particular interest in terms of the yuan. Where does yuan goes or Asian currency goes if Biden wins the presidency? And by that extension, what about Asian equities?
Thanks, Damo. Well, I think as we have discussed earlier, with potential blue wave in this election, it will likely to lead to more fiscal stimulus and more stability on.
I think Jinyeh is. We can't hear you, Jinyeh. Okay, so basically, I think we did discuss this. As Jinyeh was about to say, with a Biden presidency, and if the fiscal stimulus do get through, then basically we think that the US dollar is likely to weaken. And given especially if you look at the Chinese yuan, given the economic recovery, imagine that China is probably going to be one of the only major, not even one, it's the only major economy out there that will not see a recession this year, meaning that the economic output is probably going to be higher this year than last year, despite the COVID. So I think with that kind of backdrop, what we see is that we probably see a weaker US dollar against the RMB and against the Asian currency. I think China typically has a sort of positive impetus for the rest of Asia. And if we get that, then basically other Asian currencies will probably do relatively well as well. And with that, I mean, what we've seen historically is that a weak dollar is generally good for Asian stocks. That basically makes Asia more attractive for U.S. investors, and we should see sort of investment flow and portfolio flows into Asia and emerging market. So if we see a weaker US dollar, I think generally that would be good for Asian currencies and for Asian equities as well, right? And then there's also a question in terms of from a sector point of view, whether technology and healthcare will continue to perform going forward, or is it time for laggard like energy and financial to perform during this period of time? I think that's a good question. I think we sort of talked about from a structural point of view, tech and healthcare definitely continue to do well, and we continue to advocate staying invested in those areas. But from a technical point of view, I think from a technical and valuation point of view, I think there is a lot of good news being priced into technology and healthcare. And basically, if we see a sort of broader-based recovery as a result of fiscal stimulus and as a result of broad economic recovery, I think that's when the laggards sort of play catch up. I think whether you're talking about the industrials, the consumer discretionary, or the financial stocks would actually play catch up in those sort of market, right? So in those, I think we may see a short period in which that tech and healthcare may actually underperform the broad market. Not that it might go down, but I think it might underperform as the rest of the sectors catch up in a sort of broad recovery, whether as a result of fiscal stimulus or as a result of a vaccine that's widely available and sort of economic activity gradually recovers on a broad basis. I think we joke internally that the best vaccine play is airlines. And not healthcare, right? Because the idea is that healthcare stocks today has really priced in sort of the demand for healthcare and for vaccine, but airlines has collapsed so much, and everyone assumes that airlines are likely to go bankrupt, and it's really, really cheap. Whereas if the vaccine sort of becomes available, then air travel actually gradually recovers, and airlines actually benefit. So if you go just talk about airlines going from half book to 0.7 book or 0.8 book, that's really a very strong performance. So that's obviously half jokingly because it involves a lot of analysis in terms of which airlines to invest in. But the argument is that if we see a broad-based economic recovery, a lot of these laggards are actually going to be the one that's going to play catch up, and actually tech and healthcare may underperform in the short term, right? So basically, I think that's the sense of in the short term, we think that a broad-based recovery is probably going to be good for the laggards and the cyclical plays. Basically, there is another question in terms of given the sort of low interest rate environment and low yield environment, whether the portfolio allocation or the 60-40 portfolio allocation continues to make sense, right? I think we're starting to see a lot of debate on whether 60-40 portfolio continue to make sense in a low yield environment? I think that's basically a big debate, a big question that we have. And the answer is this, right? The general sense is that if we believe that the fixed income market is broken, meaning that bond market is broken for good, that yields are going to be low forever, or risk-free is going to be going to zero forever, then 60-40 doesn't make sense, right? Because the idea is that bond loses its ability, or at least government bonds lose its ability as a safe haven asset. It doesn't hedge against equity market volatility. In that scenario, 60-40 doesn't make sense. But we think that this is actually a temporary situation. And if we believe that this is merely a temporary situation, and when we mean temporary, we're talking about 1 to 2 years kind of situation, then basically the 60-40 portfolio from a strategic asset allocation point of view continue to make sense. But from a short-term allocation point of view, we think that we should be moving more into equities, simply because equities provide a better return today, or better risk return profile today than fixed income. What do I mean by that? Basically, if we invest especially in the sort of lower volatility spectrum of equities, in terms of the sort of the dividend equities, that actually can be a more a proxy towards high grade high grade bonds, or proxy towards towards being bond-like, right? So those are probably the areas that we advocate putting your money into it. That is, we think, I mean, especially if you are looking for sort of a absolute return kind of basis, you're not you're benchmark agnostic. You're not basically trying to track a benchmark, but you just want a steady return. I think sort of low volatility equities make a lot of sense in that area. And on the fixed income front, we basically advocate going on the credit side, on the investment grade credit. Basically, we think that in an economic recovery, default rates comes off, and therefore this investment credit probably gives us some spread, and at the same time is still fairly safe as a replacement of sovereign bonds. We also advocate a bit of high yield in the portfolio, but obviously we do suggest staying on the high quality side of high yield, and there's probably the need to be discerning, or being in terms of doing the fundamental work from the in terms of analyzing the credit quality, because obviously we know that there's going to be a lot of companies that may not survive this pandemic, and we don't want to be caught on the wrong side of that default spectrum. So definitely is something that we advocate. Jinier, are you back?
Yes, Damo, thanks for taking some of the Q&A.
Is there anything that you want to add? Is there anything else you want to add with regards to the 60-40 portfolio or 60-40 argument?
Well, I suppose I think, as Bobby Damo has pointed out, unless we think the bond market is broken, which we are of the view that over long term it is still, the theory of 60-40 still hold, and hence in the near term, because of the low interest rate environment, it will be more a case of tactically adjusting the asset allocation going forward. Yeah.
Is there any questions that you want to address from the chat, from the current chat group?
Well, I think there's one question that I pick up. are we past the trough after the market cycle, assuming a smooth election? And historically, this will be the shortest depression in just a few months, And a lot of investors, including Buffett and value investor, are still having so much cash on the sideline. What are our comments?
Okay, so basically, I think what we have seen is basically a very sharp response from government, both to the virus as well as to supporting the economy. The initial sell-off, what we saw, sort of 30% sell-off, was because people were concerned and uncertain about what the world would become in this sort of pandemic. But after that, what we saw was a very sharp response from all the governments in terms of cutting interest rates. We went from almost 2% in the US to almost 0 today on the Fed fund rate. And yield has actually followed that interest rate, that Fed fund rate downwards. And then, of course, we see a lot of fiscal stimulus being spent in order to support support income, whether in terms of business, on the business front, as well as even personal income, right? I mean, you know that Singapore spent $100 billion in fiscal stimulus. And in most countries, we are talking about all talking about double digit, 10 to 20% of their GDP in terms of fiscal stimulus. And I think, and they are continuing to promise that they will continue to support and continue to provide that support in order to make sure that the economy doesn't crash. And I think with that, I think we won't see the market testing the March low. Even in sort of a bear case scenario, what we see is probably a 10-15% correction from where we are today, but I don't think we are going to test the market low. And I think partially as also because from an economic point of view, what we've seen is after that sharp contraction in the second quarter, we've already seen a rebound in activity level in the third quarter. In fact, today, the projection for the US, I think people talk about the 30% collapse in, quarter-on-quarter annualized, on a quarter-on-quarter annualized basis, people talk about 30% collapse in the US economy. In Q3, the rebound is probably about 30% as well. So I think after that sharp contraction, we're actually seeing a very sharp rebound in economic activity as well. And I think with that, we see that the economy is probably also past its bottom. We don't expect a wholesale lockdown to happen. In most places, what we are seeing is sort of more targeted, more nuanced lockdown. Is going to be more in terms of stopping people from nightlife. You get night curfews in places like France and Paris. But basically work continues in a sense. I think as someone pointed out, you stop people from having fun, but you won't stop people from doing work, right? So I think that is probably the sort of description that we are seeing in terms of a targeted lockdown. And therefore, we see that economy sort of bounce off that low, and if we continue to sort of grind higher from here, then we think that we've probably seen the worst in terms of market as well as the economy. So yes, we've probably seen the sharpest but also the shortest recession we've ever seen in history.
Well, I think just following on from what Damo has just offered some of the explanation and answer to these questions, I think over longer term, I'm going to address one of the questions from the registration. Are you concerned on rising fear of a global debt crisis? And I suppose this is something that will be faced. Well, we have to face the reality over the next, maybe not in the short term, but 3 to 5 years down the road. The global debt crisis that will be haunting us, investor, at large. Given how much the governments are pump-priming the economy, printing money, left, right, center, developed country and even emerging countries are doing the same because of the pandemic. And eventually we will have to face the reality that the global debt become a big bubble. And what will eventually happen? While the rebound can be quite fast and short term because it's exogenous, it's not endogenous recession that we're talking about. And with vaccine coming around, things should be resolved and back to normal. But the debt problem will be something we need to face, and maybe not just our generation or our children's generation. And some potential outcome that I would like to offer to our audience over the medium long term, we could potentially see growth rebounds, as Damo pointed to, with low rates and with pump priming, multiplier effect, and then government can start implementing fiscal austerity to pull back some of these excesses. Or we will continue to have more financial repression policies, which already started and will continue in the years ahead. And some may become Japan. The Japanization over the last 2 decades, deflation, subpar growth, going nowhere for the last 2 decades could happen in some of the developed economy. In the emerging world, that we need to be careful that there will be hyperinflation, currency devaluation, like what we saw in Venezuela, in some of the weaker emerging market economies, the way that they have to get out of this debt problem. And last but not least, debt jubilees or debt restructuring that could happen. I think in one of the questions, the audience is also posting or asking us, how much more downgrade that we could potentially see from rating agency, which will happen. And we are just starting to see some of these downgrade rating actions. And it should then affect happening in some of the weaker emerging economy that cannot, sustain some of this high debt, government debt, kind of scenario going forward. And that will likely be the case for the situation that we may face where you need debt restructuring and debt forgiven to happen so that this country will be able to restart again. I think that's a longer term scenario that we may potentially face.
Okay. Junior, I saw a question that's actually quite interesting, and maybe you can answer that as well. Will the Fed run out of has the Fed run out of ammunition, in a sense that given that currently Fed fund rate is near zero, has the Fed run out of tools in terms of monetary policy if it needs to continue to stimulate the economy through monetary policies?
Well, of course, there are a few other things that we think the Fed may, if the U.S. economy is not going to recover, whether it's yield curve control, as we saw in Japan, or even negative rates in a lot of the European economy. At this juncture, of course, they are resisting and they are not thinking of using negative rates. But that's only one side of the coin. Overall, we still need the fiscal stimulus, fiscal spending on the other end. That's why if it's a blue wave and the Democrats sweep of the government, I think that will be positive because then you have both sides that supporting the recovery in the U.S. economy. So there still are some tools to go about, and I don't think they are running out of ammunitions going forward. Yeah.
Okay. I think just to explain yield curve control, I think that is basically like what the Japanese government has done is that they buy enough bonds to actually to make sure that the yield curve behave the same way, the way that it wants it to be. So, for example, in the U.S. situation, that would mean that today the 10-year U.S. Treasury is at 80 basis points, near 80 basis points. A yield curve control could be such that the Fed would buy enough 10-year Treasury to bring it to zero, so that the whole yield curve is flat from sort of the very short end all the way to the long end. We see a sort of a zero interest rate environment over a 10-year period. So that's what we mean by yield curve control, and those are still policy tools, or those are policy tools that they can use to stimulate the economy through monetary policies. And I think the interesting thing is that the general sense, if you look at Japan, is that despite the indebtedness level of the Japanese government, we don't see runaway inflation. We don't see interest rate running away. And we don't see crisis. And generally, I think that sort of creates an interesting phenomenon. I think there are people who are arguing that in this developed market, in which that if you are not relying on foreign investors to buy the government bonds, and in the U.S. case, if the Fed can keep on buying U.S. Treasury, then they are not reliant on foreign investors in buying government bond, then we don't have an issue, because you can always print as much money as you like in a developed world. You can borrow as much as you like, especially if interest rate is zero, simply because it is you are not beholden to foreign investors. What you are concerned with is basically your own domestic investor, and you can always raise taxes in future to pay off that debt, and therefore there wouldn't be a debt crisis if you are not reliant on foreign investors to buy your debt. What we've seen, debt crisis tends to happen in a lot of the less developed countries, simply because there's suddenly a loss of confidence, and foreign investors basically dump those bonds or those currencies. I think that usually triggers debt crisis in most instances, whether we are talking about the tequila crisis or the Argentinian crisis, the Mexican crisis and the Argentinian crisis. It has all been a situation of foreign investors dumping those bonds, even in the Asian financial crisis.
Yeah, thanks, Damo. And in fact, I think one other point to add is if you are the US dollar reserve currency of the world, you are probably more resilient than most of the other currencies, especially the emerging market currencies. And maybe if you don't trust all this money printing, and that's explained why gold has been rallying, and that's also one of the reasons why in our asset allocation strategy we are calling for overweight in gold. I think with that, unfortunately, we are running out of time. We have to end the Q&A session here. And once again, I want to thank all of you sending us the questions through live chat, and also during registration. So now I would like to pass back to Damo to basically wrap up this webcast.
Okay, thanks, Jinye. Before we go, probably a bit of commercial for me, especially. I like to announce, we basically want to say that UOBAM has finally launched our very own Robo Advisory App, and you can visit our website to find out more about how robo investing could be as easy as ordering your favorite bubble tea. As you can see from this diagram, and if you've seen on social media, we talk about how it is as easy as you can basically customize your investment just like you can customize your bubble tea order, right? And now you can also scan the QR code that is now currently on screen to download the app and receive $20 from us as a way to help you start your investment journey. That QR code is now on screen. I encourage all of you to basically scan and download that app to basically try out our Robo Advisor. And basically, UOBAM Invest is the way that we help you invest. It's a way that we make investing simple, smart, and safe for you, right? So basically, do go to our website or do scan the QR code to download this app. With that, that comes to the end of our webinar. Thank you, Jinye, for all the issues that you addressed. Thank you, ladies and gentlemen, for spending this last 1.5 hours with us. Please, you can actually download the materials from this webinar as well as our QIS write-up from the resources link that you have on screen. You can find a lot of resources there. We actually do quite a number of podcasts and a number of write-ups in terms of with regards to some of the issues that you have raised or the questions that you have raised. I think we basically have quite a number of write-ups there, research write-ups there. And also a reminder, please stay back for a short survey so that we can improve on our next webinars, how to make it better and more relevant and more interesting for you. So please don't go away. Stay back for that short survey. With that, thank you very much. Thank you and goodbye.
Thank you. Take care. Keep safe.